TLC The Long Con. The markets are frothing with liquidity. Part 1. By superstonk user con101smd. Read by superstonk user jedielfninja. TLC The Long Con. An Ape's Guide to Crypto Part 1. How Wallstreet conquered the Wild West of crypto by laundering funds obtained from illegal naked short selling practices through stock market exchanges worldwide. Contributors. Sources, written input, quantitative analytics, general research. User, con101smd. User, Camposaurus Rex. User, Saji Meister. Proofread by. User, Bi Triangle. User, Hey Maddie. Let me first state that I am an advocate of cryptocurrency. I believe that decentralized finance and blockchain are a disruptive and innovative technology that will usher in a new online industrial revolution. That being said, it is my belief that members from shadow banking institutions and the Wall Street elite have sought to enforce a dominating presence across the entire sector. In doing so, prohibiting cryptocurrency from truly being a free and decentralized platform for the masses. They have used its democratic potential to launder trillions of dollars from the proceeds of illegal activities, including naked short sales, not just in the United States of America, but worldwide. Contents. Preface. Chapter 1. An Ape's Introduction into Crypto. Chapter 2. So you're wondering right now, why crypto? Chapter 3. Leveraging crypto. The long con begins. Chapter 4. The crypto cartel. Chapter 5. The connection between RRRPs, crypto, and the NSCC 802 legislation. Chapter 6. The repercussions of NSCC 802. May the 4th be with you until present. Chapter 7. Fighting Fire with Fire. A GameStop NFT. Preface. I am only but a humble ape. I am not a financial advisor. I do not provide any financial advice below. Many thoughts here are my opinion, and others can be speculative. I worked in private banking and savings and investments for a big bank in the UK before moving to a competitor in which I worked in ISA investments for some time. I have always been entrepreneurial and have for some time now been GPU mining and running passive incomes through POW mining, and then evolved to using LP token creation and DeFi, decentralized finance, usage to further my portfolio progress. I run both a crypto portfolio and a stocks and shares portfolio. At this moment in time, however, I only hold one position, and that is GME. I decided to question why this is the only position I chose to hold when it came to my portfolio overall. Link. Chapter 1. An Ape's Introduction to Crypto. In crypto, you have multiple ways to create it. POW. Proof of work mining. It is the use of GPU graphics cards or ASICs to solve algebra/algorithmic equations to continue the blockchain, often done in pools of combined resources from many miners. It is needed to make the online currency work without a company or government running the show. It is a necessary part of adding new blocks to the blockchain. POS. Proof of staking. The main idea is that participants can lock coins, their stake, and at particular intervals, the protocol randomly assigns the right to one of them to validate the next block. Typically, the probability of being chosen is proportional to the amount of coins. The more coins locked up, the higher the chances. Decentralized finance and the use of LPs. Liquidity provider tokens. DeFi platforms allow people to lend or borrow funds from others, speculate on price movements on a range of assets using derivatives, trade crypto, insure against risks, and earn interest in savings-like accounts. DeFi uses a layered architecture and highly composable building blocks. Some DeFi applications promote high interest rates but are subject to high risk, the majority of which are built on the ERC20 network. However, alternative networks are available for the same practices. The E network is prevalent due to the ability to create smart contracts with Link. A smart contract is a self-executing contract with the terms of the agreement between a buyer and a seller being directly written into lines of code. The code and the agreements contained therein exist across a distributed, decentralized blockchain network. The code controls the execution, and the transactions are trackable and irreversible. Smart contracts permit trusted transactions and agreements to be carried out among disparate, anonymous parties without the need for a central authority, legal system, or external enforcement mechanism. While blockchain technology has come to be thought of primarily as the foundation for Bitcoin, it has evolved far beyond underpinning Bitcoin itself. Smart contracts render transactions traceable, transparent, and irreversible. Explain like I'm an ape. I make a spreadsheet, add a column that the person who I send it to can insert their username. They send the spreadsheet to the new user, and so on. The information submitted by the previous member isn't erasable. Once that information is submitted onto the spreadsheet, it will always remain. The only thing you can do is to add a new entry and pass it along. How smart contracts work. A brief history with Link. Smart contracts were first proposed in 1994 by Nick Szabo, an American computer scientist who invented a virtual currency called, quote, BitGold in 1998, fully 10 years before the invention of Bitcoin. In fact, Szabo is often rumored to be the real Satoshi Nakamoto, the anonymous inventor of Bitcoin, which he has denied. Smart contracts are defined as computerized transaction protocols that execute terms of a contract. He wanted to extend the functionality of electronic transaction methods, such as point of sale, to the digital realm. Szabo also proposed the execution of a contract for synthetic assets, such as derivatives and bonds. These new securities are formed by combining securities, such as bonds, and derivatives, options and futures, in a wide variety of ways. Very complex term structures for payments can now be built into standardized contracts and traded with low transaction costs due to computerized analysis of these complex term structures. In simple words, he was referring to the sale and purchase of derivatives with complex terms. Many of Szabo's predictions in the paper came true in ways preceding blockchain technology. For example, derivatives trading is now mostly conducted through computer networks using complex term structures. Smart contracts today are used in DeFi to create and generate wealth through liquid provider tokens, LPs. This is a non-physical way of creating crypto and is based around the fundamentals that can stake your asset, or you can use DeFi, by which you add your funds to a giant liquidity pool in which the more funds in it, the easier the flow of transactions in and out to bounce off other currencies against it. In short, you get paid handsomely to be an automatic market maker through what's called smart contracts. In return for staking your assets in these liquidity pools, you are paid a live, constantly rolling interest payment that works out an average maybe 100% per annum. These interest payments can be capitalized and compounded in your initial investment. In other words, while you buy and hold a crypto, you are earning a constant high-yielding dividend payment on it and still have the ability to move funds in and out without any hindrance or clauses. Here are two of the DeFi platforms that are popular that I have experience in using: PancakeSwap with Link and Uniswap with Link. To put the incentives into perspective, Currently, right now, on the most popular DeFi exchanges, you can earn up to 120.47% APR at time of writing, compounded and capitalized as often as you want. At the start of the year, some of these pools were running at 500 to 600% APR compoundable. The shorting hedge fund model worked prior to the May the 4th by utilizing these exchanges. NSC 802 curtailed the bulk of that, leaving little choice but to store excess funds on 0% in overnight reverse repos, essentially going from highly profitable assets to assets being eaten by inflation. More perspective. The US 2-year Treasury is 0.16% yield. The US 5-year Treasury is 0.78% yield. The US 10-year Treasury is 1.49% yield. The average ETF investor earns 8% APR. The average S&P index investor earns 10% APR. At time of writing, now currently increased to 0.05%. Chapter 2. So you're wondering right now, why in the fuck am I talking about crypto on superstonk? First, we need to consider what money we are talking about, where it comes from, and any previous proof, paper trails to consider, or unusual correlations. We know the correlations with costs and other meme stocks. The backstory, looking closer. Please check below a chart of GME versus USD, ETH, and Bitcoin with link. When there is a large price increase in GME, the price of Ethereum goes down $1 compared to GME. When there is a large price decrease in GME, the price of Ethereum goes up compared to $1 USD GME. If it is a small change in GME price, the correlation is not necessarily there, but it is always there when there is a substantial net change and always follows the same pattern compared to the day before. Basically, the price of Ethereum compared to 1 USD changes based on large changes in GME price, and it is dependent on a rise or fall and always follows this pattern. All we need to do is see the closing price of Ethereum and other tokens, compare them to GME price. You can find significance based on price change always. And a very quick TLDR. You can use Bitcoin to purchase tokenized stocks, which are then convertible to the real stock. So if you purchase the stock with Bitcoin while Bitcoin is high, then it costs less Bitcoin to buy the stock, especially if you pump the market in preparation for it. So pump crypto market, then buy your GME shares through tokenized stocks. The broker comes out even or a bit ahead since the tokenized stock trades a couple dollars higher than the real stock, and the short hedge funds just bought GME with an inflated currency compared to USD. The crypto rule that dropped the price may have prevented this, and it shows on the inflation comparison of crypto compared to GME. The tokenized stock market was a way to purchase their FTDs at a lower price, then screw crypto holders after. I included a graph in the analysis of the change in price from the previous day of GME, ETH, and Bitcoin. I understood the data when I first reported it. It appears Ethereum and Bitcoin get pumped with GME. Link. As you can see, there is some correlation for sure with GME and the top two cryptos. The correlation seemed to diverge after March and correlate strongly on the highest FTD cycles and accompanying price drops. I will dive deeper into this correlation later in this DD. Credit, Sadumeister. Why is there a correlation? Where is all the money going to from naked short selling? It is my belief it is the same money, This leads me on to my follow-up question. Where's it coming from and where going to? Naked short selling globally, Lucy Kosumar, stated the UK was far worse than the USA. It's a global problem. Being a British ape, this caused alarm bells to go off in my head, and then it dawned on me just how large of a scale of a problem it is. An interesting example, with link. Citadel Securities banned for 5 years in China because of illegal practices, with links. The key points we need to take away from this article: the usage of HFT, taking advantage of loopholes for arbitrage purposes. Don't worry, we will briefly cover arbitrage. This will be important later on. Also, futures trading. And Citadel were probed for spoofing, a practice that involves placing and then canceling orders, distorting the price in the process. Hedge fund predatory usage of global malicious short selling. Q. Now, where have we seen that happening before? Answer. Well, stonks. With link. It will take for them to be liquidated to be covered. With link. If a short sold GME share is costing Citadel Securities in interest, for example, then to at least make the balances a net position, they need to look for somewhere that they can place the funds. All of a sudden, the influx of buy orders increases. This was not part of the plan. Citadel needs somewhere that can get a return of more than the interest on the borrowed shares to remain net neutral at best. Time to put on the thinking cap. Holding cash, it's expensive. Time is your enemy. TikTok, with link. Say, for example, I had a mountain of cash like Pablo Escobar's. Then as long as it can be parked somewhere safe, I don't care if I lose a small percentage due to rats and inflation. At the end of the day, I own it. It's my money. I can do what I want with it. The short hedge funds dilemma. Not just Citadel Securities, but numerous financial institutions have the same problem. They currently hold too much money, but get this, it's a bit harder to fix. You see, they don't own the pile of money, but just possess it. Naked short selling, simply put, is borrowed money. Let me remind you how this compares to what a bank does. It uses other people's money to make profit for itself and then hands it back when asked nicely. So having sold short hundreds of millions of shares, not just across the New York Stock Exchange, but globally on many companies, all of a sudden this giant pile of cash needs a new home on the books. But the fundamentals are different. It's still borrowed money. Unless, as a bank, you never intended to cover, that is. For example, interest on, say, let's see, a GME share currently works out at 1% on average. Back in January, this interest was hitting 82.9%. 82.9% APR. A shorting hedge fund needs to start looking outside the box. They have amassed so much capital through short selling that accruing interest is no longer a viable option. Citadel can't just sit on all this extra cash. It has to be put to work or else there will be problems. The fundamentals haven't changed. Short sold shares are still borrowed money. With link. Chapter 3. The Long Con begins. Leverage in crypto. Quote, "They mistook leverage for genius," unquote. Steve Eisman. The industrialization of cryptocurrency and adoption of crypto wealth creation by the shadow banking sector. On April 24, 2018, the DTCC submitted new filings that essentially gave shadow banking free rein to have their cake and eat it. Quite literally, Cake LP tokens. Please find below a press release submitted by the DTCC, which was enacted by 1 May 2018, with link. April 24th, 2018. While significant progress has been made during the last 8 years towards establishing a global reporting framework for over-the-counter derivatives transactions, substantial work remains in the areas of data consistency, aggregation, and access in order to be able to effectively monitor and reduce system risk, according to a white paper published today by the Depository Trust and Clearing Corporation, the premier post-trade market infrastructure for the global finance services industry. In its latest white paper, quote, a progress report on OTC derivatives, trade repositories, many miles traveled, more yet to go, unquote. DTCC calls for continued focus on the definition and adoption of data standards and the exploration of opportunities to leverage new and emerging technologies. Link. Enter the use of DeFi cryptocurrency and LP liquidity provider token yield farming. Stablecoins. The use of liquidity provider tokens and smart contracts. Crypto synthetic assets. Hold up, say what now? With link. Stablecoins in a nutshell. Stablecoins try to tackle price fluctuations by tying the value of cryptocurrencies to other more stable assets, usually fiat. Fiat is the government-issued currency we're all used to using on a day-to-day basis, such dollars and euros, and it tends to stay stable over time. Usually the entity behind the stablecoin will set up a reserve where it securely stores the asset backing the stablecoin. For example, $1 million in an old-fashioned bank, the kind with branches and tellers and ATMs in the lobby, to back up 1 million units of the stablecoin. This is how a digital stablecoin and a real-world asset are tied together. The money in the reserve serves as a, quote, collateral for the stablecoin. A user can theoretically redeem 1 unit of a stablecoin for 1 unit of the asset that backs it. There is a more complex type of stablecoin that is collateralized by other cryptocurrencies rather than fiat, yet still is engineered to track a mainstream asset like the dollar. Link. And thus, there lieth the problem. Let's get acquainted with Tether. Link. 1. Tether's total consolidated assets exceed its consolidated liabilities. 2. Tether's total consolidated liabilities exceed the quantity of tokens in issue. 3. Therefore, Tether's reserves exceed the quantity of tokens in issue. Following this logic, quote-unquote reserves must equal total consolidated assets. Link. The fact that Tether's reserves are cash equivalents doesn't matter, but what does matter is capital. For banks, funds, and other financial institutions, capital is the difference between assets and liabilities. It is the cushion that can absorb losses from asset price falls, whether because of fire sales to raise cash for redemption requests or simply from adverse market movements or creditor defaults. Tether has very little capital. The gap between assets and liabilities is paper thin. With link from March 31st, 2021. Stablecoin holders are thus seriously exposed to the risk that asset values will fall sufficiently for the par pegged to USD to break. What money market funds call, quote, breaking the buck, unquote. The money market fund reserve primary MMF broke the buck in 2008 due to significant losses from its holdings of Lehman paper. Its net asset value only fell to 97 cents, but that was enough to trigger a rush for the exit. Reserve Primary became insolvent and was eventually wound up. Asset price falls could similarly result in Tether breaking the buck. But unlike Reserve Primary, stablecoin holders wouldn't be able to get their money out if asset values fell. They would either have to try to sell their stablecoins on exchanges or sit tight and hope that asset values recovered. It's the risk of asset price falls that is the real problem for the holders of Tether stablecoins, not lack of cash for redemptions. Tether's asset base consists almost entirely of assets that are exposed to the risk of default, illiquidity, and sudden price falls. I will demonstrate how stablecoins are being used for liquidity later on with my introduction of NSCC 802. Tether's asset base consists almost entirely of assets that are exposed to the risk of default, illiquidity, and sudden price falls. We don't know how serious the risk is, but it's reasonable to assume that the worse the rating of the assets, the greater the likelihood that the par peg will break. Link. Tether from June 17th, 2021. Arbitrage. In economics and finance, arbitrage is the practice of taking advantage of a price difference between two or more markets, striking a combination of matching deals that capitalize upon the imbalance, the profit being the difference between the market prices at which the unit is traded. It is a chain of transactions whose purpose is to make a profit on the difference in crypto prices on different exchanges. In other words, we buy for less in one place than sell for more in another place. The main thing is not to confuse yourself with all the movement of funds. The most common reason for the difference in price is a lack of liquidity on one exchange versus another. Link. Pick. Visual on a trader's approach to arbitrage. Note. Hedge fund prolificacy and their usage of high-frequency trading and Wallstreet constantly scouring all markets using AI searching for arbitrage to profit from. The addition of crypto to the financial world, therefore, would be no different. It simply just increases the size of the pool of liquidity for the fish to swim in. Another quick example of an unstable stablecoin. Link. On May 20th at 1 a.m. UK time, you can see a deviation breaking the buck. This coin also has synthetic assets in the form of tokenized coins tied to it. Arbitrage reference. 88 cents when it is supposedly tied to the 1-to-1 US dollar. More than a 5% deviation indicates a breaking of the buck. On May 19th, Wallstreet had liquidity tests. This is arbitrage and an unstable stablecoin. Ask the question, who is authorizing a currency to be created out of thin air backed by the Federal Reserve in dollars? Where is the money going to? It's an under-the-counter form of shadow inflation. Physical dollars get printed, e-dollars get minted, 1-to-1. Tether is minting 1 billion UST at a time, but understand this. It is also a private entity, not in U.S. jurisdiction, but even more, it's anonymous. What the fuck? Now, let's look at what can be built on the back of Tether/UST. Synthetic assets. Despite sounding confusing and kind of sci-fi, synthetic assets aren't all too difficult to wrap your head around. To understand synthetic assets, the first thing to know is that they're derivatives, and derivatives are leverage. Let's define what derivatives are. A derivative is any asset that derives its value from an underlying asset or index. Suppose a derivative's value is tied to the value of another asset via a contract. In that case, we can trade the movement of that value using trading products like futures and perpetuals. Instead of using contracts to create the chain between an underlying asset, the derivative product, synthetic assets tokenize the relationship. This means that synthetic assets can impart exposure to any asset in the world, all from within the crypto ecosystem. A synthetic asset is simply a tokenized derivative that mimics the value of another asset. Imagine that you want to trade GameStop stocks without holding the GME asset itself. Using a synthetic, you can trade MGME, synthetic mirrored GME, instead, which behaves like the underlying asset by tracking its price using data oracles such as Chainlink. Question: who could potentially go long on an anonymous MGME when they know the brakes may be applied on a short sale, for example? Answer: with link. A shorting hedge fund. Advantages of crypto-synthetic assets versus traditional derivatives. Traditional derivatives were once groundbreaking in their ability to unlock additional value from assets like equities. However, crypto-synthetic assets are taking liquidity access to a whole new level. Here are just a few advantages synthetic assets have over traditional derivatives. Anyone can issue them. Blockchain-based synthetic assets can be minted by anyone using open-source protocols like Synthetics and Mirror. Worldwide liquidity. Synthetics can be traded on any crypto exchange in the world, including unstoppable decentralized exchanges. Borderless transfers. Synthetic assets or blockchain assets like ERC-20 tokens, you can send and receive them between standard cryptocurrency wallets. Frictionless movement. Switch between equities, synthetic gold, silver and gold, and other assets without having to hold the underlying asset. Generally speaking, synthetic assets enable far more liquidity across global exchanges, swap protocols, and wallets than traditional derivatives are even remotely capable of. Synthetic assets make tokenizing and trading anything a reality. The sheer power of crypto-synthetic assets become more obvious the closer you look. Imagine that anything, not just assets like equities, can be represented as a synthetic asset token and therefore be brought onto the blockchain. By enabling anything to be tokenized and brought into the blockchain, synthetic assets unlock untold pools of global liquidity. Apart from simple market buying, selling, and derivatives trading, synthetic assets create possibilities for seemingly infinite markets and combinations of new sources of value. Example: imagine a synthetic asset token that tracks corporate CO2 emissions in an industrialized zone. When emissions rise, token holders, these may be locals living nearby, city officials, and outside speculators, profit as the companies issue CO2 tokens. However, when emissions decrease, the companies profit by retaining tokens, incentivizing them to continually reduce CO2 emissions. Synthetic asset-based markets like these are just some of the ways synthetics break trade out of the mold. Let's dive into tokenized assets. Full credits to Saji Meister. This section will dive deeper into regulations surrounding tokenized stock coins and their potential connection to GameStop FTDs. Please see post from blank, who was the original bell ringer for the conundrum. What are tokenized stocks? With link. Quote, tokenized stocks are tokenized derivatives that represent traditional securities, particularly shares in publicly listed firms traded on regulated exchanges such as Tesla, Apple, and Facebook, or ETFs like SPDR and S&P 500. The key benefits of tokenized stocks include fractional ownership of traditional securities, 24/7 access to markets, and greater liquidity, to name a few. These digital assets are backed one-to-one to traditional stocks, entitling holders to the same economic benefits of owning the underlying stock. Tokenized stocks are a tokenization of a digital total return swap contract. similar to contracts for differences. The tokenized stock's value is based on and collateralized with the underlying asset, a traditional security, typically a publicly traded equity. And the value of the digital asset is determined by the value of the traditional security. For example, they are collateralized by an equivalent notional amount of the traditional security, i.e., $100 of the debt derivative would be collateralized with $100 of the traditional security. This allows tokenized stocks to mirror the economic performance of the applicable reference traditional securities. Quote, tokenized stocks may also represent innovative baskets or indices of traditional securities as well as traditional securities plus cryptocurrencies, for example, the S&P 500 and Bitcoin. Tokenized equities may also include leverage as well as long or short exposure, from bitrex.com, end quote. Well, that is interesting. It is a derivative of an actual stock. It is essentially a convertible. Remember this because it will become important later. One thing to mention briefly here, because I will not touch on it later, is that the last paragraph says Bitrex also has convertible ETFs. A bonus tidbit is that they have a tokenized ETF basket which contains, well, just read it straight from the press release. The Wallstreet Bets Index, or WSB, officially trades under the ticker WSB-0326 and tracks the price of 5 stocks and 2 cryptocurrencies. Thus, the index is made up of shares from Nokia, BlackBerry, AMC, GameStop, and iShares Silver Trust, and Dogecoin tokens, and FTX token, FTT. Source, with link. January 27th. Guess what tokenized stock gets added to FTX during the height of the January squeeze? You guessed it, GME. Link. Wait, that is not the only one. They also added a bundle of Wall Street Bets favorites. You can also guess this was done on January 27th. Citadel and FTX. Guess who gets added as their first president on May 14th? A freaking Citadel executive. Source. Harrison will be in charge of helping FTX US, quote, massively scale out, unquote, FTX.US CEO Sam Bankman-Fried said in a statement Thursday. Harrison's expertise is in developing trading technology. In his most recent role at Citadel Securities, Harrison was head of systematic technology, and where he oversaw a team of more than 100 engineers. Link. Robinhood and FTX. The chief operating officer is Sina Nader, who previously headed the crypto business at Robinhood. Oh boy. Quote, with link. So let's summarize ownership. Founder is a former trader on Jane Street Capital's ETF desk. President is former Citadel exec of Semi-Systematic Technologies. Chief Operating Officer is the former head of crypto at Robinhood, Sina Nader. Nothing to see here. No conflicts of interest for sure. FTX and head of SEC Gary Gensler, with link. A look into volume of tokenized stocks in FTX, with link. As you can see in the graph above, on January 28th, the volume of synthetic GME traded was somewhere at 5.129 million. I believe this is in USD, so let us use $200 as the average price for this day. 5,129,000 divided by 200 equals roughly 25,000 shares. This doesn't seem like much, but in order to trade this number of shares, then you would need to have the token backed by actual shares. Well, the broker who purchases the shares to back the coin is CM Equity. Well, as you probably already have guessed and can look up yourself, CM Equity does not claim to have any ownership of shares in SEC filings. Did you also know that Bittrex and Binance also have tokenized GME stocks as well as other meme favorites? Bittrex and Binance are also backed by stocks purchased from CM Equity. So 3 major tokenized stock dealers who are backed by actual stocks custodied through CM Equity, but yet CM Equity does not have any SEC filings. Very strange. Next, we will look at onboard volume for FTX GME tokens. Link. So the onboard volume shown starts from the first day GME was offered, January 27th. The volume starts positive, then goes to negative. So OBV is just the volume from second day minus the volume from the first day, and then it accumulates every day. Why would the OBV go negative to negative 5 million volume? That is a $10 million change since the original position and appears to show a net short position among traders. Short positions. Search FTX all day and night and you won't find anything about short positions on tokenized stocks except in their FAQ, frequently asked questions, with link. So something short exposure. It will take more digging to figure out exactly what is going on with the short exposure, but I will find it eventually. Tokenized stocks FTD Theory 1. Pump and dump crypto to purchase GME FTDs at a lower price. So now that we have a clear understanding of what tokenized stocks, let's dive into a theory on how shorters and FTD holders can take advantage of this. As you know, you can purchase tokenized stocks with any accepted crypto on the exchange. You can then trade in your token for the actual share using CM Equity. The Long Con, Part 3. The first theory is straightforward. You can pump up the crypto market when buying your FTDs through CM Equity so that your crypto is worth more when purchasing your FTDs. You then liquidate your pump in order to not have some other whale take advantage of your pump. For this to be true, you would see crypto prices increasing from the previous day as GME goes through major FTD cycles. The below chart represents some correlation regarding change from previous day on GME, Bitcoin, and Ethereum. Link. As you can see, there is some correlation for sure with GME and the top 2 cryptos. The correlation seemed to diverge after March and correlate strongly on the highest FTD cycles in the accompanying price drops. This is only Bitcoin and Ethereum. Mapping out other altcoins such as Doge would also give more data points. The theory is simple. Start pumping crypto prior to January because you see the writing on the wall. Doing this allows you to use some of your inflated assets to purchase GME shares. You could always liquidate crypto to do this, but my gut feelings is something happened in January where the liquidation of crypto was not giving them the best bang for their buck. So they got with their friends in FTX, Bittrex, and Binance to create these stock tokens for the Wallstreet bet meme stocks. The claim by these companies was to give retail the opportunity to trade these without the fear of trading interruptions that were going on with Robinhood. So when did Robinhood prevent users from selling on their app? 1/28/2021. These companies created these tokens the day before and even got all of that approved in hours through their custody partner CM Equity, just to fight off the evil Robinhood for retail. Yeah, okay. Tokenized stocks FTD theory 2. Using tokenized stocks to move their FTD cycle to T plus 35. SEC regulations on short sales. With link. Let us get into the boring SEC stuff. I had to pry my eyes open for hours to understand this mess. So what are the borrowing and delivery requirements for a short sale? Below is taken straight from the SEC rulebook that is in effect today. Quote, B. Short sales. 1. A broker or dealer may not accept a short sale order in an equity security from another person or effect a short sale in an equity security for its own account unless the broker or dealer has, unquote, I. Borrowed the security or entered into a bona fide arrangement to borrow the security, or II. Reasonable grounds to believe that the security can be borrowed so that it can be delivered on the date delivery is due, and III. Documented compliance with this paragraph, B1. That seems straightforward and reasonable, but wait, of course the rules don't apply to everyone. See the next clause, which is an exceptions clause. I only pasted over the two important ones relating to this post. The rest can be found here in section 242.201 with link. Quote 2. The provisions of paragraph B1 of this section shall not apply to II. Any sale of a security that a person is deemed to own pursuant to 242.200, provided that the broker or dealer has been reasonably informed that the person intends to deliver such security as soon as all restrictions on delivery have been removed. If the person has not delivered such security within 35 days after the trade date, the broker-dealer that effected the sale must borrow securities or close out the short position by purchasing securities of like kind and quantity. Transactions in security futures. So as long as you can deem to own it, following any of the exceptions laid out in 242.200, then you now have extended your delivery timeline to 35 consecutive days from the date of purchase. You can also legally have short sale transactions in security futures. Interesting. Did you know there are security futures in tokenized coins? Don't worry, we'll get into that later. What the hell is in section 242.200, short sell and marking requirements? Let us dive in. Quote, 242.200 definition of, quote, short sale and marking requirements. A. The term short sale shall mean any sale of a security which the seller does not own, or any sale which is consummate by the delivery of a security borrowed by or for the account of the seller. B. A person shall be deemed to own a security if 1. The person or his agent has title to it, or 2. The person has purchased or has entered into an unconditional contract binding on both parties thereto to purchase it, but has not received it, or 3. The person owns a security convertible into or exchangeable for it and has tendered such security for conversion or exchange, or 6. The person holds a security futures contract to purchase it and has received notice that the position will be physically settled and is irrevocably bound to receive the underlying security. But now we can see that there are 3 possible ways already under 242.200 where it is possible to do some tokenized coin fuckery. Rules 2, 3, and 6 are what we are going to focus on, but let's get into some terminology that we will have to get familiar with first. Security futures contracts. Quote, a security futures contract is a legally binding agreement between two parties to buy or sell a specific quantity of shares of a security, i.e., common stock or an exchange-traded fund, or a narrow-based security index at a specified price, on a specified date, in the future, known as the settlement or expiration date. If you buy a futures contract, you are entering into a contract to buy the underlying security and are said to be long the contract. Conversely, if you sell a futures contract, you are entering into a contract to sell the underlying security and are considered short the contract. The price at which the contract trades, or the contract price, is determined by relative buying and selling interest on a regulated. End quote. From FINRA. So it is a contract between two parties to buy a security or index security in the future of a specified price. One common asset that this is done with is oil. The price of oil is very volatile, so to handle some of that volatility, a refinery will negotiate a futures contract of oil. Let's say oil is trading at $80 a barrel, and one entity on the deal thinks oil will rise and the other thinks oil price will drop. To make a win-win contract for the future and handle your balance sheets better, you negotiate future contracts on the price of oil. So you may agree to pay $90 in a month for 1 million barrels of oil. How do futures on tokenized stocks work? Information from tokenized stockbroker FTX below. Quote, FTX also lists futures on tokenized stocks, including tokenized futures. Tokenized stock futures will track FTX spot markets as their index. They will work the same as futures on other FTX products with the following conditions. 1. In the case of an ordinary dividend, the futures will not have any adjustments. 2. In the case of many other corporate actions, including stock splits, significant spin-offs, etc., futures will adjust, either by changing denominators or by turning into a future on the whole basket in the case of spin-offs. FTX reserves the final right to determination. Futures expire to their index, generally the FTX spot markets, over the relevant TWAP period. Source, with link. So what is the difference between options and futures? An options contract gives an investor the right but not the obligation to buy or sell shares at a specific price at any time, as long as the contract is in effect. By contrast, a futures contract requires a buyer to purchase shares and a seller to sell them on a specific future date, unless the holder's position is closed before the expiration date. Investopedia. Link. So you can get out of a futures contract at any time. Well, let us look into Investopedia again. What about getting out of a futures contract? Quote, the investor may instead decide to buy a futures contract on gold. One futures contract has as its underlying asset 100 troy ounces of gold. This means the buyer is obligated to accept 100 troy ounces of gold from the seller on the delivery date specified in the futures contract. Assuming the trader has no interest in actually owning the gold, the contract will be sold before the delivery date or rolled over to a new futures contract. As the price of gold rises or falls, the amount of gain or loss is credited or debited to the investor's account at the end of each trading day. If the price of gold in the market falls below the contract price the buyer agreed to, the futures buyer is still obligated to pay the seller the higher contract price on the delivery date. End quote. So initial collateral is needed. In the case of tokenized stock futures, you can also have to have collateral in your account that can purchase the entire futures contract. There is a leverage allowance for crypto, but not tokenized stocks. You can use tokenized stocks as collateral for crypto futures and vice versa. Here is a snippet regarding using the tokenized stock as a collateral like crypto tokens. Tokenized stocks are spot tokens like Bitcoin, Ethereum, FTT, etc. They can also be used as collateral for futures trading on FTX with a collateral weight of 0.85 and 0.80 for total and initial, respectively. End quote. Source, FTX futures. Here is how you post collateral for futures in FTX. with source. Collateral for the futures is in stablecoins. The current set of accepted stablecoins is USDC, TUSD, and PAX. To deposit or withdraw collateral, go to your wallet page and deposit either USDC, TUSD, or PAX. Depositing either will credit your account with USD, which is automatically used as collateral for all of your future trades. By default, all margin is posted in USD in your wallet. USD can be funded by depositing USDC, TUSD, PAX, BUSD, and HUSD. Balances of the following coins also count towards collateral. With link. Tying this into GME. So how can this help shorties? Well, look at Rule 6 that allows you to use the T plus 35 rule. 6. The person holds a security futures contract to purchase it and has received notice that the position will be physically settled and is irrevocably bound to receive the underlying security. Well. So shorters such as Citadel can make a futures contract that they hold full collateral and will purchase the stock at a certain price in the future. FTX allows for leaving the contract at any time, so in order to meet SEC rules, they would have to prearrange a future settlement where Citadel has to purchase the shares at the end. 3. The person owns a security convertible into or exchangeable for it and has tendered such security for conversion or exchange. Or, so as long as shorters own a convertible and have tendered such security for conversion or exchange, they can use T plus 35. Basically, shorters can purchase stock tokens and make an arrangement for future conversion. That's where the gray area is, and Citadel hiring an SEC official can help them out. The futures contracts can also work out here. Arrange a Bitcoin conversion in the future based on the current inflated rate and pay the Bitcoin up front, knowing the Bitcoin price is very inflated. 6. The person holds a security futures contract to purchase it and has received notice that the position will be physically settled and is irrevocably bound to receive the underlying security. Well, with this loophole, you do not have to pay up front. You only have to have a legally binding contract to purchase the security at a future date. Make the future contract with inflated crypto prices, then liquidate and purchase shares with your liquidated Bitcoin price. Pump a coin, trade a synthetic asset mirror stock at a high base coin price. Coin falls in price. You still own one synthetic GME. The synthetic GME is still like for like, but the underpinning coin's value is volatile and fluctuating. This creates arbitrage to buy and sell MGME based on the foundation of a volatile underlying coin, for example, Doge, Bitcoin, Ethereum, or even a private coin, allowing for windows to profit in. Mirrored stocks and shares. Maybe someone doesn't want you to see. MGME/UST with links. Here's one they prepared a little earlier with links. UST MAMC. But hold on, why stop there? Planning on shorting ETFs? Remind me who was shorting ETFs. Let's make some money. Well, look at what else peaked around the time as nearly everything I've covered in this DD. Talk about morning glory in May. Even better still, it's a mirrored synthetic asset-based off yet another privately unstable stablecoin. There's a lot of synthetic assets derivatives tokenized off the stock market based on unstable stablecoins, isn't there? That sure is a lot of layers, isn't it? Quick fire question. Do you know what else has layering in it? Answer. Money laundering. So let's ask ourselves, where do these synthetic assets originate from? A bit like our little house of cards due diligence and our discovery of rehypothecation, let's see where the rabbit hole takes us. Chapter 4. The Crypto Cartel. JP Morgan, Goldman Sachs, CME, Bank of America, Barclays. Some examples of platforms currently trading publicly. Without a doubt, there are many more off exchange and out of view. Meet oxygen.org. Interesting tidbit for you, with link. Oxygen is a DeFi prime brokerage protocol to help get trading leverage, generate yield, get liquidity, borrow to short against your portfolio of digital assets. They state, tested on trillions of dollars in the real world. More projects of the same kind. Mirror finance. Synthetic asset protocol for creating and exchanging fungible tokens tracking the price of off and cross-chain assets. With links. Synthetics.io is a decentralized synthetic asset exchange protocol enabling anyone to mint, exchange, and provide liquidity for a vast range of assets. With links. ftx.com/en, who we referenced above in the tokenized assets section. I say no more. With links. A look at some of those credentials. With link. And who might have close ties to CME? Meet the FUD maker himself. I don't know what a digital token is, Ken. With links. Isn't that an interesting turn of events? Slap bang in the middle of it all, Kenny himself. Note that all previous receivers of this award have all been recognized for disruptive technology's advancement. Why did Ken, quote, I don't know what a digital token is for, unquote, Griffin get awarded? Q. You're telling me that the head of the largest handler of retail order flow in the U.S. markets, who won an award for innovative contributions in his field, doesn't know about the innovative disruptive technology that is going to revolutionize the very industry he champions? Bull. Shit. Their involvement in the crypto markets is to ensure that they come out on top. It's all about power. Look at the core team. All are common names on the shorting hedge fund news headline cycles. The same names keep cropping up. Even if you take CME out of the equation and look at the other banking institutions involved, it's normally always the same appearances in the credits. Just a little fine print fact. The rules that apply to every single one of us don't apply to Ken. He's special and well, to be honest. I just love reading the back of shampoo bottles when I'm sat on the toilet. So if I see T's and C's, I'm all over that like a fly. With link. If he was a retail customer, he would have to ban himself. With links. Many links. Now this rounds us onto an exchange called linear finance. I dug into that rabbit hole too. You really should go play dot to dot too. Let me just repeat what I mentioned a few pages ago. Apart from simple market buying and selling and derivatives trading, synthetic assets create possibilities for seemingly infinite markets and combinations for new sources of value. Here's a link. Let me show you that correlation again. It's justified. With link. Voila. The result of hedge fund and market maker fuckery with synthetic assets. Do you see now? Definitely going to have to look at all the graphs and links posted here. The Long Con, Part 4. What is a black swan? A black swan is an unpredictable event that is beyond what is normally expected of a situation and has potentially severe consequences. Black swan events are characterized by their extreme rarity, severe impact, and the widespread insistence that they were obvious in hindsight. Key takeaways. A black swan is an extremely rare event with severe consequences. It cannot be predicted beforehand, though after the fact, many falsely claim it should have been predictable. Black swan events can cause catastrophic damage to an economy by negatively impacting markets and investments, but even the use of robust modeling cannot prevent a black swan event. Reliance on standard forecasting tools can both fail to predict and potentially increase vulnerability to black swans by propagating risk and offering false security. Examples of past black swan events. The crash of the U.S. housing market during the 2008 financial crisis is one of the most recent and well-known black swan events. The effect of the crash was catastrophic and global, and only a few outliers were able to predict it happening. Also in 2008, Zimbabwe had the worst case of hyperinflation in the 21st century with a peak inflation rate of more than 79.6 billion%. An inflation level of that amount is nearly impossible to predict and can easily ruin a country financially. Now reconsider how GME, Bitcoin, and ETH correlation looked in Chapter 2. Do you see now? Let me show you that correlation again. It's justified. With link. Voila. The result of hedge fund and market maker fuckery with synthetic assets. Do you see now? Chapter 5. The tether between crypto, reverse repurchase agreements, and NSCC 802. I know you know what I did there. With link. I noticed something interesting. This piqued my curiosity and I dove a bit into a few different coin charts and had a look at volumes traded. We can only assume that stablecoins do not fall into the same categories as the majority of other cryptocurrencies. Due to DTCC reporting, we can only see outlines of initiatives that are enforced. However, rarely do we get to see the inner workings of the fine print on the paperwork. In my interpretation, a stablecoin being pegged directly to the USD would not be subject to material adverse change, as it is a like-for-like coin. This is a strong conviction of mine. However, the NSCC 802 filing breakdown simply confirms legislation, but that we as the average person are not privy to the inner workings of that information. Link. Tether, one of the stable coins. Redbox. Now this is describing the link. Okay, in the link, we have the red box highlighting. Funny how the volume dramatically increased right around the time NSCC 802 was enacted. Surely it's not just a coincidence. In the link, we have the orange box highlighting what happened on either May 13th and subsequently May 19th that could affect this increase again. Something happened on May 13th, as this interestingly coincides with the day that GME started its uptrend. BTC and ETH also bottomed out around this time at a flat 30,000K per BTC and 2,000K flat per ETC. Another coincidence? No. It was because of Wallstreet liquidity stress tests and subsequent follow-up tests on May 13th and May 19th because someone has been trying to hide too much cash. Link. When the filing SR-NSCC-2021-802 was posted, I can remember at the time hearing grumblings about crypto not being accepted as liquidity on balance books, but had never considered its ramifications. Please find below some of my findings. On page 14 of SR-NSCC-2021-802, April 29th, 2021, with link. So in the NSCC filing, it defines that the only acceptable form of, quote, qualifying liquid resources, unquote, to include, among other things, lines of credit without material adverse change provisions that are readily available and convertible into cash. Now, this filing was on April 29th and had 5 business days to be enacted. This takes us to May 4th. Remember how I briefly touched on DeFi Uniswap and PancakeSwap? We'll have a look at this. You can see volume increases similar to short sold volume on GME. Every spike in volume relates to a movement in GME. They were parking their money in places where the daily returns were better than the daily interest cost to borrow the shares. Note: LP token volume connection to GME short volume. Nearly all the DeFi pools peaked on May 3rd evening time, rolling into May 4th. The Dogecoin pump and dump. Please find below an unusual Dogecoin e-wallet that the quants checked out. This wallet has been analyzed by our quant8 team, and we have deduced that there is a high probability that this account in particular has been active in illegal and fraudulent market manipulation. If you look within the account here, with link, please see in the above sample, image 1, which is this account for Dogecoin holdings. If you see the section I have highlighted, you can see very clear unusual activity. We believe that this specific account is in advance mass purchased Dogecoin with the sole intention of a future pump and dump scheme. The purchase was made long before any true media spotlight or notable increases in volume from retail investors. The spike took place on 8 July 2020. The days prior to and after also had unusual activity. If you look at both accounts, please find below attached Dogecoin wallet number 2. This account has also been flagged by our quant team as having transacted under suspicious circumstances. If you look at the section I have highlighted, this is 8 July 2020. The day before and after, there was unusual activity on the account. This activity correlates with the account in image 1. Please then see image 3 below. Looking at image 3, you can see the deviation between the high and low prices throughout the day on July 8th. If you look at days either side of these transactions, you can see further unusual activity between the same 2 accounts on July 7th and July 9th. It is on this evidence that I conclude that these accounts were used to artificially inflate the price of Dogecoin by making transactions back and forth at overinflated prices, by doing so inflating the market cap, and on paper making it look like they have a lot more assets on their books than they actually do. But also by inflating the coin, they essentially test the viability of a pump and dump scheme. If you look again on images 1 and 2, you can see another connection in which transfers were made between accounts on the 13 March 2020. A further spike and retrospective dip. I believe this was a test round. Image 4. The spike on May 8, 2021 was due to an appearance on SNL, Saturday Night Live. This is only a running thought on a certain ominous TV appearance. Said person dealt with a history of shorts on their company themselves over the latter half of the 2010s. With short positions having been squeezed out, it resulted in many long positions being opened in that company. Said person was stuck between a rock and a hard place. If Doge tanked, his company tanked. Doge was used to inflate shorting hedge fund books who were long on other companies. Therefore, if Doge increased, it gave hedges time to fight another day. I therefore ask you to think again the use of FTX with Doge. Who is rumored to be the largest holder of Doge? Do you see? The Bitcoin accounts with unusual activity. As identified by some members of our Quant8 team, the world's fourth largest Bitcoin account, eWallet 1P5Z, and a working slush subsidiary, eWallet, with links. One of our quant apes ran some analytics on several interesting Bitcoin accounts that have flagged up multiple times, with link. Please look at the attached doc folder containing a list of the high volume pass working downwards to lower volume pass in order of significance. If you look at significant dates such as January, you can see interesting activity, and through other date ranges I have mentioned spikes. As much as these accounts are interesting, unfortunately there was no conclusive connection to draw from them, but I felt that they are worth mentioning as they were part of my research into GME and crypto. Take this information as you wish. Also note the list of subsidiary temporary holding accounts. Chapter 6. The Repercussions of NSCC 802. If you notice on every single graph and chart I've presented to date, all have peaked in early May 2021. From Star Wars Day, the crypto market started a downturn. Interestingly, on introduction of NSCC 802 on April 26th, whilst awaiting to be initiated, Bitcoin rallied as Wallstreet emptied DeFi, TVL, total value locked, and consolidated their portfolios into Bitcoin. Post Star Wars Day, all crypto TVL began its decline. This led to some $900 billion loss in total value of the crypto markets. The global crypto market cap was over $2.5 trillion, only to decline to $1.37 trillion as of 9 a.m. UK GMT time over the period of May 4th, 2021 to June 21st, 2021. Link. Too many goddamn coincidences. Follow the money. From my understanding of reading the legislation in NSCC 802 with, quote, qualifying liquid resources without material adverse change provisions, unquote, means that Tether, likewise, many other stablecoins, are not classified under the same asset grouping and therefore are not impacted by this ruling. It is certainly possible that we are looking at some of Kenny's potentially laundered tendencies right here. In essence, the money that was withdrawn from interest-yielding projects was cashed out and converted into stablecoins and Bcoin, ensuring books would balance as needed. There are still large sums of hedge fund capital amassed in these projects. Not everything was withdrawn. Only enough was withdrawn as necessary to balance books. So you would think that with NSCC 802 in place, that would be the end of it, but hold up. Kenny figured out how to buy himself another few days. Please find below a few charts of recent activity of a small sample of many searchable coins, all of which show interesting patterns in and around early May. With link. There are a whole host of similar coins, all with similar upticks and start dates in and around the start of May 5th through May 13th. Above is a small sample. If you scroll back up and check that tether chart with the orange and red boxes, look at around the start of May and May 13th for me, could you? See? Privacy coins and their suspected use by hedge funds avoiding margin calls. Q. Can you hold a privacy coin synthetic asset on paper that is untraceable? You could maybe even call it capital X. Boomers aren't creative. I bet it was actually recorded in the books under the name capital X. Who knows? Privacy coins are a class of cryptocurrencies that power private and anonymous blockchain transactions by obscuring their origin and destination. Some of the techniques used include hiding a user's real wallet balance and address, and mixing multiple transactions with each other to elude chain analysis. However, Privacy coins handle two different aspects: anonymity and untraceability. Anonymity hides the identity behind a transaction, while untraceability makes it virtually impossible for third parties to follow the trail of transactions using services such as blockchain analysis. See below. Privacy coin purchased en masse from 1 hour after NSCC 802 was enacted, with link. The coin lay in wait until it was called upon on June 15th, yes, only yesterday, to help balance the assets and liabilities in a hedgie's books. They buy the coins for pennies, then sell a couple back and forth at overinflated prices in the thousands, by doing so inflating the market cap and on paper making it look like they have a lot more assets on their books than they actually do. To balance out their liabilities, naked short positions. So when did our reverse repo rates kick off? Oh, go on, let's have a wee look and see. It looks like the exponential rocket ignited sometime between May 3rd overnight and, oh my god, May the 4th be with you, right before Cinco de Mayo Day happened. Reverse repos simply signify that at this current moment in time, there is nowhere safe to park spare capital whilst being able to hold it in assets to balance books. Therefore, I cannot deduce that the increase in reverse repurchase agreements are directly caused by shorting hedge funds short selling. However, it does indicate that the markets are frothing with liquidity. Another interesting connection is the date in which NSCC 802 was presented. Look at the date our RRPs started, even before the May 3rd dip. I also refer to the chart of Bitcoin showing the NSCC 802 enactment and liquidity test day, making the connection that it was shadow banking sector / hedge fund money in crypto that was rug pulled and hence initiated the decline of the crypto markets. With links. I believe that prior to the NSCC filing being passed and enacted, the shorting hedge funds have been using DeFi proof of stake coins to hide a lot of cash, and that had been amassed from having sold short so many shares across the field, not only in GME. If you look at the correlation of when the reverse repo rates ignited, it is the same time of this filing, the same time crypto POS tanks, and the same time that the NSCC enacts the filing to prevent crypto being used as liquid. I believe that prior to May 4th, these coins have been the primary location for hiding funds gathered through naked short selling. And prior to May 4th, these coins were considered liquid assets on the bank balance sheets. Post May 4th, they are no longer considered liquid, but rather assets, and so we then saw the overall downturn of the crypto markets. There was further information late April, early May that precluded that crypto due to reclassification as an asset rather than liquid would be eligible for different tax status, commodities and equities taxes. Part 5. Chapter 6 continued. The flight to quality. May 4th and Cinco de Mayo Day. That wonderful little bit of NSCC 802 legislation that was key to try and stop malicious short selling in the markets. On page 14, with link, it states that, quote, qualifying liquid resources, unquote, to include, among many other things, lines of credit without material adverse change provisions that are readily available and convertible into cash. By parking money with the Fed in the form of reverse repo rates, many institutions are no longer receiving the hefty profits they once were achieving through crypto, DeFi or staking, not just shorting hedge funds, but all of Wall Street. Timeline courtesy of user Time Peng. Thank you very much, Kind Ape. You rock. End of Q1/March. DTC and the creditors realize this is not going away. April 1st, DTC-005 announced for review. The nuclear option would blow up GME shorts and also everyone else in the market running similar scams. April 8th, NSCC-802, announced for review, comments, etc. A tactical nuke revealed. By removing the ability to leverage crypto markets simultaneously for revenue and collateral requirements, the short position will be unsustainable. April 12th, DTC-005 pulled indefinitely for, quote, reformatting. With the tactical nuke in place, no need to keep full-scale Armageddon on the table, right? May 4th, NSCC-802 takes effect. Tactical nuke detonation. May 5th, overnight repos explode. Many DDs suggest that overnight reverse repurchase is a liquidity problem framed as a collateral problem. It's both, because the tactical nuke hit both. Now, remember the way I mentioned several dates. April 26th. This was the cutoff point for NSCC 802 to be contested. It was not contested. RC tweeted on April 26th that everything was on track. April 29th was the date that NSCC 802 would start to be initiated to be completed by 4th of May. RC tweeted on April 29th a meme of Mr. Hanky, the penny drops, with link. The tidal waves from that iceberg crashing into the water are coming, with another link. We sit and watch chess and checkers being played in the lobbies of Wall Street. Soon it will be a game of dominoes in the shadows that will shine the greatest light. Chapter 7. Fighting Fire with Fire, a GameStop NFT. With links. Are you ready to set a new ATH? What is an NFT? An NFT is a non-fungible token. That means it's a token you can buy, sell, and hold. Unlike most cryptocurrencies, there may be very few or only one of an NFT, and they might be indivisible, meaning it may not be fungible with any other tokens. NFTs can take a number of forms. Sometimes they can be redeemed for a physical object. Sometimes the owner is entitled to an experience, like a movie or a phone call. Sometimes they're associated with a digital image. Sometimes they're associated with nothing at all. Sometimes they can even be worth negative 1/12 DVF. With link. Buy, hold, buckle up. Every path followed is the same path walked. Another link. Can't stop, won't stop, GameStop. I am not a cat. This has been a presentation of The Long Con by superstonk user con101smd. Read by superstonk user jedielfninja.